As a part of our strategy, we run a multi-cap portfolio, and that is also part of a philosophy where we invest in both large caps and mid and small caps. Large caps typically form 60 to 70% of our portfolio, and the rest is mid and small caps. The idea is to get a stability of large caps and capture the high growth in mid and small caps. So both earnings as well as stability is there. In addition to that, we also look at the management of the companies in a very close light, because they are the ones who run the company and can generate long-term returns for the shareholders. From a numbers perspective, we look at the return on capital of a company to be higher than the cost of capital. We look at the other part of the returns in terms of earnings growth should be higher than the average earnings growth of the sector. And lastly, and most importantly, we look at the balance sheet. So we like companies where debt equity ratio is low and the cash flow comes back to shareholders instead of all going to the bondholders. When we evaluate various themes for our portfolio, certain areas stand out, and those are the areas where we are overweight. First one is consumption. Consumption is a big theme in India because it has a huge population of 1.4 billion people. We are hitting the per capita income of $2,500, and that is where the J curve is expected to happen, as it happened in Japan in 1980s and in China in 1990s. So we do expect the same to happen for India. Now consumption can be played through various methods. We can get exposure through owning hotels, retail companies, different kind of consumption, airlines companies, and those are the areas where we have strong exposures, even eating out and home delivery. So that really excites us as an opportunity. Other way of getting exposure to consumption is financial services. So most of the financial companies owned in our portfolio have exposure to home loans, personal loans, credit card loans, and auto loans. So these provide the opportunity to get exposure to these areas. In addition, insurance is the other area where there's a big underpenetration, and we see a big growth opportunity. Lastly, on consumption side is exposure to the equity market, because people are putting a lot of money into the equity market from domestic investors, and we want to get exposure. So we can own a discount brokerage company, we can own an asset manager as a part of the portfolio. The last part of consumption is healthcare. So healthcare, we own hospitals in our portfolio. Hospitals are a very good proxy to the whole healthcare demand in the country, and also pharmaceutical companies. Pharma companies are both domestic as well as exporters. So domestic market itself is growing at more than 10% per annum, and globally we are a big supplier of pharmaceutical drugs. In addition to consumption, we have a very positive view on manufacturing. So manufacturing in the area of chemicals, electronics, pharmaceuticals, because government is encouraging to manufacture and go local and reduce the reliance on imports from countries like China. So that is the other theme. Infrastructure is a big growth area. We've doubled the number of airports over the last 5 years in the country. We are building the first bullet train between the cities of Mumbai and Ahmedabad, and one will be done. We'll build more bullet trains going forward. So overall, it's a very big theme where 35 cities have got metro network over the last 5 to 7 years, and we are building more and expanding the existing metro networks. Coming to the third theme, what we like is telecom. So India has a huge population again, and the demand for data is growing exponentially. And this provides a very good opportunity for us to invest in telecom companies where the tariff continues to be one of the lowest in the world. You pay $3 a month and you get 1 GB of data every day. So that's the kind of low tariff you're talking about. So from here onwards, tariff can go only up. The places where we are not positive is Indian IT services in our portfolio, because Indian IT services get mostly exposed to the US and the European market as their clients, and that is where the challenge lies in the current context, where we don't know what is going to happen in terms of tariff globally and especially in these markets. The other area where we have typically been underweight is oil and gas sector. There we obviously like Reliance Industries, which is the largest company, and Reliance is into oil and gas plus telecom plus retail, so we like them. But apart from that, we've been very selective in oil and gas, government-owned companies, where government does interfere at a point of time whenever the crude oil prices go up. So there we are always very, very concerned and careful in terms of our investments. So overall, we run a very balanced view on the portfolio. In terms of mid and small cap, we try to restrict our holdings to maximum 3% for a mid cap name and 2% for a small cap name, so that in the times of, when the challenging times, mid and small cap fall more, and then they become more volatile in nature and less liquid. So we have to manage the exposure on the mid and small cap side in a judicious way so that we are able to generate more stable returns. As a result of all this strategy for us, we've done almost 13% compounded returns in US dollar over last 9 years since this fund was started.